And now it gives me great pleasure to introduce two of my colleagues, Reezwana, a recent recipient of the Young CFA Analyst of the Year Award for 2021. Congrats, Reezwana, and Richard. And they're going to have a conversation around fixed income and how it pertains to monetary and fiscal policy. I'll hand over to both of you.
Hi, good morning. Thank you very much for the introduction. And I apologize if my screen's a little bit blurry, but it's the result of some unannounced load shedding. So before that occurred, I was super bullish on the market, and now I've just become super bearish. But anyway, without further ado, we'll get into the presentation that myself and Reezwana have put together. And I don't know if that slide has been put up for the guests. Can that be confirmed?
Yeah, we're looking at page 3, right?
Okay, perfect. Reez, good morning. We don't have too much time, so let's get into right at the beginning. What does the QPM, or for those who are not in the know, the quarterly projection model, suggest for the interest rate outlook? And do you agree with such an outlook?
Yeah, good morning all. Thanks, Richard. The SARB's quarterly projection model is essentially the forecasting model that they use to forecast a repo rate trajectory, so an interest rate trajectory, and forecast inflation for the next 3 years as well as growth. The SARB's QPM, as you can see on the bottom left-hand side bar chart, is currently forecasting just over 10 hikes of 25 basis points each to the repo rate by the end of 2023. And you can see how that's evolved as the output gap, or the difference between actual and potential growth tends to close or narrow. We see that the QPM becomes more hawkish, forecasting more increasing number of hikes. Currently, as I've indicated, the QPM is forecasting a repo rate at around 5% by the end of 2022, and then just above 6% by the end of 2023. Now, our forecast and our research, we've shown that the ideal time to hike interest rates in order to reduce future inflation and future inflation expectations is when you have a combination of things. So when inflation and inflation expectations are low, when growth is high, and when the credibility of the central bank is high, that's when it tends to be an ideal time to begin hiking interest rates. In this type of an environment, the negative impact of higher interest rates, so the negative impact on growth, will be felt immediately over the next 2 quarters, and then the cost or the impact on growth declines sharply thereafter. So ideally, the central bank would want to hike interest rates when growth is quite high. If you think about sort of the outlook for 2021, indicated by earlier presenters, our chief economist Nikki Weimar, also indicating that growth, real GDP growth for this year is expected to have recovered quite sharply from last year. So growth is essentially expected to be high this year, well above 4% perhaps. And then if you think about inflation is currently low relative to South Africa's history. So we currently have inflation and inflation forecasts that are close to 4.5%, and inflation expectations are also close to multi-year lows. The SARB is quite credible, and as a result, we have a bit of a different view. While we do think that the base case is for the repo rate to be hiked, or the hiking cycle to start in the first quarter of 2022, if we are wrong, then we probably will see a hiking cycle sooner, or begin sooner rather than later. So the SARB could possibly end up hiking rates sooner and end up requiring to hike less, rather than waiting for 2022 or well into 2022, and possibly having to hike by more. So our bias is, as you can see the chart on the bottom right, how we differ. We're not quite as hawkish as the QPM or the SARB, but we're not on the other side of the equation, where if you look at Bloomberg consensus, seeing a much more tepid or drawn out hiking cycle in 2022 in particular. So our base case is for hikes of between 75 and 100 basis points over the next year and a half until the end of 2022. So that tends to be our view, and as I've indicated, we won't be surprised if the SARB were to hike sooner, so possibly November this year at the November MPC meeting. In terms of what the market's pricing in, Richard, what is the FRA market pricing in, and what's your view? Do you agree with that?
Yeah, thanks, Reez. So the FRAs for the next year are pricing in 100 basis points of hikes over the next 12 months. So that effectively is 4 hikes of 25 basis points. I'm not in that camp. I actually don't believe that there is the need or the necessity by the SARB to hike interest rates as aggressively as that. I think it may be a little bit more tepid and it may be a little bit more stretched out, just looking at the data. And there's two things which come to mind for my view on that. And I must caution that this is not a consensus view on the desk, but simply the view that I've taken, is that the SARB in the Q&A session at the last MPC meeting did suggest that they would be comfortable with negative real rates for a period of time as long as inflation remained contained. And I've taken this to mean that they will delay hiking interest rates for as long as possible. And I think as long as you're seeing the continued resilience in the currency, you're seeing the continued strength in commodity prices, and you're seeing accommodative monetary policy not only from the Fed in the US, but from other developed market central banks, I think there will be this pent-up demand for high-yielding assets. And I think, perversely, that'll keep the rand better bid, it'll keep our bond yields lower. And I think that given the structural impediments that the country faces on so many fronts, I think that the SARB will err on the side of caution and will not hike if they don't have to. So I kind of believe that although I think that we are at the bottom of the interest rate cycle, I think it is going to be lower for longer.
Okay. Thanks, Richard. Definitely, if you look at the economy, the recovery will back to post or rather pre-pandemic, pre-COVID levels will take between 2 and 3 years to actually get there in terms of reaching a GDP at that level. The consumer is obviously in a fairly weak spot currently, with unemployment levels quite high. And so in that type of environment, if a hiking cycle were to be delayed, would definitely be supportive of growth. However, given that the communication by the SARB of the last few meetings has been fairly on the hawkish side in our view, and given that some of the empirical studies have indicated that perhaps when growth is high, tends to be an ideal spot or time to begin to start a hiking cycle. It will be interesting to see how the SARB weighs up the counterbalancing factors there.
Excellent. Reez, a lot has been also spoken about in terms of the issuance profile from National Treasury, and a lot of people have weighed in that our debt is unsustainable. But over the last few months, we've seen a significant reduction in the weekly issuance, both on the nominal bonds as well as the inflation-linked bonds. How was National Treasury able to do this and do it so aggressively?
Yeah. If you can move on to page 5, maybe if you look at pictures, it'll be better to explain. So we did have a bit of a reprieve when it came to tax revenue collection, particularly from November of last year to currently to currently, we've seen tax revenue collection tick up well above a National Treasury and SARS forecast. We had SARS come out in April indicating that revenue collection was about 38 billion rand higher than they were expecting in February at the time of the February budget. And we've had very strong demand in the primary auctions. The non-competitive auction, bond auction, has been gone quite well, particularly after National Treasury raised it to 100% allowance. It's now dropped obviously back down to 50%, reducing the size of the non-com auctions. But I think overall demand in our primary auctions have been quite strong. Because of that, what ended up happening was last year, National Treasury and the government ended up raising their cash balance by over 100 billion. So that's the top left bar there. It's been the biggest annual increase in cash, in the government's cash position, obviously on record. And to put that into perspective, as early or as recently as February, National Treasury was only forecasting a 52 billion rand increase in their cash in the last fiscal year. So almost a 50 billion rand extra cash that they've obtained because of better tax revenue collection last year. And better demand for bonds. As a result of that, the government had to sort of adjust its financing strategy. It's how it would like to pay or fund the budget deficit for the new fiscal year, the 2021-2022 fiscal year. Given the substantial rise in cash, its cash position, if you look at the bottom left-hand chart, remains at the highest ever recorded. It would make sense to use more cash or bigger portion of cash to fund part of its budget deficit for this year. Apart from the fact that we ended off last fiscal year with a bigger cash balance than previously anticipated, higher growth estimates for this year imply that growth will probably be revised higher by the MTBPS, higher than the February budget. So currently we've got National Treasury forecasting an 8.8% nominal GDP growth for the 2021-2022 fiscal year. We think that probably gets revised up to at least 9.2%. What that means is that in combination with better GDP growth, one can make the assumption that revenue collection will take up. We have seen very strong and high commodity prices, and tax revenue from some of the mining companies will probably surprise to the upside as well. Also, very early estimates indicate VAT collection is higher, excise duty is higher. Some of the items like sin taxes, tobacco, alcohol, and even the general fuel levy likely to bring in more tax revenue. So we are forecasting at least a 34 billion rand revenue overshoot for the current fiscal year, and this will probably be much higher if these trends persist, or as we go into the fiscal year. Because of those factors, it made sense for National Treasury to reduce the issuance profile. I'd also like to state that if the revenue collection or the revenue overshoot is much higher than our forecast, so for example, a revenue overshoot of about 80 billion as opposed to the 34 billion that we're seeing, then debt issuance can reduce even further by around 800 million per week in terms of the bond issuance. So there is scope to reduce weekly bond issuance further, with the caveat that obviously revenue toes the line, and we see better revenue collection persist through the course of the fiscal year. I've explained, why issuance was reduced, because obviously expecting a narrow budget deficit means that they have a smaller financing requirement. But Richard, what have you been seeing on the desk in terms of the smaller supply of debt in the weekly auctions, and what has this done to the curve, essentially, the bond curve?
So the bond curve has flattened quite aggressively, but it's happened in stages.
Perhaps move on to the next slide.
Thanks, Reese. So yeah, the bond curve has flattened, but it has occurred in stages. So the initial reduction in the weekly issuance was pretty much telegraphed when the budget was announced, and the market had preempted that there would be a reduction in the issuance both for the nominals and the inflation-linked bonds. And as a result of that, the flattening happened, but it wasn't as aggressive as some had anticipated. We then subsequently actually started to see the curve re-steepen, but that was also coincided with when US Treasuries were under significant pressure, and people were then starting to talk about the reflation trade and the potential for Treasuries to move north of 2%. So it was kind of more of a global phenomenon than anything else. What caught the market offside, though, and caused some significant flattening, which we're still continuing to see today, was the second reduction in issuance. That was not anticipated. We had known there were multiple calls by economists and analysts to reduce the issuance further post the budget, given the cash that government was sitting on. But my own personal view was that National Treasury, given how cautious they've been in the past, would probably wait until the medium-term budgetary policy statement before deciding whether they would reduce it. But be that as it may, they did reduce. It surprised the market, and the market has rallied and the curve has flattened. And that just means that your longer-dated bonds have outperformed your front-end bonds, and quite significantly. For those who don't know, our bond curve goes all the way out to 2048 on the nominal bonds. So we've got a very sustained and developed bond market, and we're able to plot it along their entire yield curve. So the curve has flattened. And what is interesting, it's not only so much against the 5-year bond, which is probably more aligned to what is happening in monetary policy, but it is flattened against the 10-year bond, and that gives you a better indication. Now, what the benefit of that is, obviously our financing costs and our borrowing costs reduce quite substantially. But whereas if you take in the US, their 30-year bond, where that flattens, it has a more direct impact with the consumer, as their mortgage rates are directly correlated with the 30-year bond. So it may not be felt in the consumer's hand at the moment, but certainly turns in the borrowing costs for the country. It's been a massive boom to the tune of around about 80 basis points for the 2048s.
Yeah. So from a fundamental perspective, that is particularly the reason why our fair value for the 10-year and the 30-year has dropped. So in the very near term, country risk premiums have declined, and as a result, we maintain now we've got a fair value of between 8.50 and 9% for the 10-year, and between 10.50 and 11% for the 30-year. So about a 50 basis point reduction in fair value yields, predominantly because of the near-term impact of a better fiscus than previously forecast, and the impact that would have on country risk premiums. And Richard, in line with what you've been seeing in the bond market, that tends to be the tactical view. So that tends to be a very short-term view in my view over the next 3 months, particularly because we still have that risk of the wage bill negotiations that are ongoing, that could potentially add upside to spending or government expenditure if the wage increases was announced close to 4%. So that tends to be a more longer term strategic view, that perhaps the near-term impact or the near-term benefit to the fiscus is purely just that, was concentrated over the next 3, possibly 6 months. And further out, we're going to need to see evidence from government with regards to structural reform implementation, possibly better growth estimates, and fixed investment growing in the economy to really get more build up from a fiscal perspective, and how that would impact the bond curve. Those are some of my thoughts in terms of the difference between the short term versus the long term view when it comes to the bond market.
What potentially can derail the revenue and growth forecasts for South Africa over the next year?
Yeah, there are a couple of looming threats, and also many sort of left field developments. COVID last year was certainly a left field development. Over the next year, so if South Africa were to experience a severe third wave, moving up lockdown levels and constraining physical and economic activity further, that will obviously limit the upside to growth and potentially reduce growth estimates depending on the severity of the restrictions as well as the wave itself. And if you look at globally, obviously, as earlier presenters mentioned, South Africa have been lifted by this sort of global recovery. If we were to see an abrupt end to this global commodities boom, for example, or if the global recovery is hampered by resurgent waves or variants of COVID that we need more vaccines to be developed, that will definitely impact not just South Africa, but other emerging markets globally. Other left field developments that could significantly impact growth would be any negative political developments. So key ministerial changes, for example, if you think of National Treasury, if you think of the presidency itself. So that tends to impact growth and confidence levels, and that tends to be drawn out. But for now, as I've indicated, that's not our base case. For now, in at least over the next 6 months, we tend to be sort of benefiting from this global uptick and better revenue collection, essentially for the current fiscal year.
That was a stimulating conversation, but time has caught up with us, and really nice to hear about that close link to both of you. Thank you for your insights with respect to the monetary and fiscal policy and how the two interact with each other. And I think in the interest of time, we do need to move on, and really great to have you both on the program in terms of your passionate discussion and conversation. Ian, I'd like to ask you a few questions. What have you seen in terms of client behavior in the pandemic as it relates to your portfolio?
Thanks, Francis. Yeah, it was a very interesting time and quite a tricky time. And I remember, it was probably between March and July where liquidity was absolutely key for clients. Clients were looking to place large amounts of cash at the time, so our cash balances probably went up by 20 to 30 billion over that period. But clients always wanted that reassurance of liquidity. And clients were phoning us and saying, we'll place 500, but we might need it in 4 days' time. And we always had to make sure that was available. So with our investment partners, to Quanta, we were constantly on the phone, making sure we spoke to banks on a regular basis, making sure there was proper liquidity in the system. And Reezwana referred to one of the slides where the SARB raised a lot more cash. I mean, the pricing of the TVs went up significantly because some of the banks, particularly international banks, were declining deposits. They were full up with deposits from the asset management industry, and they didn't want more cash from us. So we had to look for alternative sources. The TBs were a great source. Yields were picking up. Actually, probably some of the TBs were paying higher than the banks. And so we did find a home for them. I think that there was lots of cash in the system, which worked well for us at the time, even though it was a very nervous time. I do think that's going to reverse. We have seen situations where dividends have resumed. I mean, one of our mining companies paid 5-6 billion rand dividend a couple of weeks ago. And I think that will unwind. I think companies will resort back to infrastructural spending. Will a mine sink another shaft? Will a retailer put up another DC? So I think that will start resuming. The confidence levels are looking better slightly. I think the key of that period was liquidity management. And I think we've got a great model with Quanta where we manage the liquidity incredibly well. I mean, we get a very good sense of when clients need the cash. We build models. And sometimes we surprise our clients by telling them that they are going to draw down today, and they sometimes forget. So we've looked at those models quite well. So that was, I think, was great. But on the innovation side, you guys have been doing lots of work there. How's that progressed? And I think clients have got some exciting things ahead for you.
Yes, thank you for the opportunity. I think it's good to hear about those green shoots that we've heard people speak about today, and that plays to working capital and the opportunities that it presents. And as I mentioned earlier, but our own behavior has changed, and digital platforms enable that. And just to elaborate quickly on two items, watch this space. We are going to launch a fantastic platform to enable treasurers and owners of enterprises to manage their daily banking business a lot more simply with the benefits of digitization with respect to simple tasks like opening accounts. As I mentioned earlier, the influence of supply chain finance into the working capital cycle playing a bigger role. And as the economy starts to recover, working capital will play its role, and Nedbank will play its role alongside our clients in assisting them.
Great stuff, Francis. Thanks for joining us. It's been great to have you guys with us. Thank you very much.
Thank you both.